Welcome to day 2 of the Moss Adams Private Foundation virtual conference. We're pleased that you're able to join us. We have 5 sessions today, totaling 5 CPE credits for today's portion of the conference. For the National Association of State Boards of Accountancy, to qualify for these credits, you must attend each session for a minimum of 50 minutes and respond to at least 3 of the 4 polling questions in each session. There's a link to the agenda in your handouts window. During the 40-minute break, we will be switching to the afternoon sessions. There is a link in your console that will take you directly to the afternoon sessions. However, if you have trouble with that link, you can also find it in your email and calendar appointment. And before we get started, I'm going to play a brief housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and now I would like to turn it over to Wendy Campos, Partner and Foundation's National Practice Leader, to get our conference started. Wendy?
Great, thank you, Amy, and welcome. Good morning. If you joined us for day 1, welcome back. This is day 2 of our Moss Adams Private Foundation Conference. I also wanted to let you know we're recording all sessions, as Amy mentioned. We have another great agenda planned today with an impressive lineup of speakers, and I hope you're all looking forward to day 2. Now I'd like to introduce our next session. Our next session is the Form 990-PF, Attorney versus Accountant through a different lens. And I'll quickly and briefly introduce our speakers. We have Maggie Elliott, a senior manager with Moss Adams. She spends almost exclusively all of her time with exempt organizations, in particular with private foundations. We also have Marisa Meltebeke, a partner with Davis, Wright, Tremaine. And I'll keep her bio short, but it definitely doesn't do her justice. We work with her jointly and collaboratively with a number of clients, and it's a pleasure to have both of you with us. I will be moderating the session. We're going to open it up with a polling question right off the bat, so I'll turn it over to Amy.
All right, thank you, Wendy. So the first polling question is, how familiar are you with Form 990-PF? And your options are A, I'm an expert, I know it all, B, somewhat, or C, I'm new to it all. And we will give you a few moments to respond. To respond, you're going to click the button next to the answer you choose, and then make sure to hit the Submit button so that it records your response. And it looks like people are pretty quick this morning, so we'll leave it up for about 5 more seconds. All right, Wendy, here are the results.
Wendy, I think you're muted.
Sorry about that. Well, great. We've got 59% somewhat and 32% new to it all. So I think you'll still learn from something from this session. And even the experts, I know, even those of us that work day to day with this form and with private foundations, there's always something new to learn or something more complex in the areas that you already know. So we will go ahead and I will just introduce this section and turn it over to Maggie and Marisa. We're going to dive into some specific sections of the 990PF where we really want to highlight specific areas. Remember that this form is open to public inspection, including the Schedule B and contributor detail, which is different than a public charity Schedule B. Maggie, why don't you go ahead and start us off and talk about the header and part 1 of the 990PF, and then Marisa, obviously would love to hear your perspective from the legal side, especially with complying with the public inspection requirements.
Thank you, Wendy. So with part 1, the first page, a lot of information starts off here and is front and center. So in the heading, we typically just want to make sure that all the information is accurate. The organization's name, EIN, obviously the address, should an address change, you're able to do that via the form by checking the boxes. Areas that usually catch my attention is the accounting method. Of course, I'm coming from the accounting side, but being cash or accrual drives obviously the part 1 revenue and expenses, how they're presented, but it's also important in how this form asks for information, because regardless of whether you're on cash or accrual basis for your book purposes, column D is always on cash basis. So charitable disbursements in general are on cash basis only, so only the funds that are actually spent would be reported there for the year. Net investment income, the column B, is of course of interest because that's really the only income that generates taxable income. So it's subject to the 1.3.9% tax rate, any net income that's there. And otherwise, I think this really is an area that an accountant would focus a lot more time on, but just curious from your perspective, Marisa, if you ever look at this, or if you do request, a Form 990PF from a client or a 1023, if you really pay attention to this.
Your hunch is correct, Maggie, that, the accounting pieces are things I focus less on, but to kind of reiterate the importance of the 990 being public, and I don't think that's probably a surprise to anybody. I think we're pretty used to being able to pretty easily access other organizations' 990s. GuideStar is really easy. The IRS exempt organization search now is starting, I guess not starting, it's been a couple years, but you can go and access the 990s. So, these forms are long and I think they can get tedious, but it's obviously kind of important to remember that, what you put on this, you're putting out into the world. And then kind of closely related but separate, I don't think it surprises organizations that their 990 might be made public. It's important to realize that the same kind of disclosure regime that applies to the 990 also applies to your exemption application. And I think we have a lot of compliance with the 990 public disclosure kind of by default with the IRS putting up and GuideStar. I find a lot of organizations push back on the idea of I have to disclose my exemption application if somebody asks for it, but I think that's just something for organizations to remember. Your exemption application is also subject to public disclosure, so if somebody asks for it, your obligation is to provide a copy. And they can also ask for it from the IRS. It just takes a lot longer, but eventually they can get their hands on it. So always be thoughtful about things you're putting on these documents that can go out into the public domain.
That's a very good point. And this form does on part 7A or part 6A now, line 13, does ask if the private foundation has complied with all the public disclosure requirements, which would include the 1023. So there is a check and balance for that information as well. And with that, we're kicking it off with a lot of polling questions this morning, but Amy, we have a polling question coming up next.
All right, thank you. So the second polling question is, my organization follows FASB ASC 958. True, false, or I'm not sure. And then just a reminder, if you would like to receive CPE credit for this particular session, you will need to respond to at least 3 of the 4 polling questions. All right, we'll do a little bit longer. Make sure you hit submit after you select your response. All right, here you go.
All right, so 64.8%, I'm not sure, and about 28.5% true. Well, this is a good lead in to the next portion of the 990PF that we're going to talk about. And ASC 958, I'm not going to pretend that I know all the FASBs because I'm on the tax side, not the audit side, but it's definitely mentioned in the instructions and on the line items in the balance sheet of the second page of the 990PF. So with that, Marisa, can you speak to that particular section? Not that particular section. I know for you, it's more the narrative behind this reference. It's not the section of the form, but really would be interested in your thoughts on the FASB ASC 958 and how it relates to the 990PF lines 24 and 25.
Yeah, and I think this is an area where, in working with Maggie and Wendy on this presentation, some of the areas on the 990PF are areas where your attorneys and accountants are speaking the same language. And then I think there's areas where we're not. And that's obviously very frustrating, and I haven't solved it yet. But for me as an attorney, when I'm very interested in, do you have assets with donor restrictions? And if I had answered that polling question, I would also say I'm not sure. I'm not familiar with the FASB, but I do care about your donor restrictions. And in particular, as an attorney coming at this, I want to know, has a donor imposed restrictions in writing on assets it gave to your foundation? And this isn't a tax thing. So I think this is probably why the accountants and the lawyers are speaking a different language here. But I think you're probably all familiar that as a foundation, you need to use your assets in furtherance of your mission. You need to use your assets in a manner that are consistent with the obligations of 501c3. But there's these additional restrictions that can apply to assets depending on how you receive them from the donor. So if the donor just gives you money, that's great. Those are unrestricted assets from my perspective. You can do what you want with them within the parameters of being a C3 private foundation. But a donor might not always do that. A donor might enter into a gift agreement and say, I'm giving you this money, private foundation, but only if you agree to use it for scholarships. I'm giving you this money and I want you to maintain it as an endowment. I want you to maintain it as an endowment for scholarships. And that creates legal obligations and restrictions on those assets. And so, again, it's not really a tax issue. This isn't the IRS that's going to come knocking to say, are you complying with your donor imposed restrictions? The IRS wants you to comply with 501c3. But there is a state law. It's the Uniform Prudent Management of Institutional Funds Act. We call it UPMIFA because that's a really big mouthful. And you guys might be familiar with this. I think charities that manage investment assets are familiar with UPMIFA. UPMIFA, among other things, helps provide guidance to charities with investment assets regarding, what's prudent management of your institutional funds. How do you manage those assets in a way that satisfies your fiduciary duties? How should you allocate income off of an endowment for expenditure? And so I think what sometimes gets lost in UPMIFA, there's also a provision about donor imposed restrictions. And so when your attorney's saying, do you have restricted assets? What I want to know is, did a donor at the time they made the gift impose a restriction on the foundation's use of that? And so the two kind of broad categories of restrictions are going to be the purpose for which the foundation can use the gift. So, that's like, you have to use it for scholarships. You have to use it for renovating the building. Or it can be on the timing of when the foundation spends the money. And that's usually an endowment spending restriction. So language about only spend the income, language about, maintain this in perpetuity, that's going to create an endowment spending restriction, which means the foundation can't spend it all now. They have to maintain it as an endowment, and then, can only spend income and earnings off of it in light of maintaining that asset in perpetuity. And so that can be, it's a challenge. It's an administrative challenge for organizations to keep track of these assets. And it's much easier to do it up front than to try to go back and piece together your, donor agreements from way back when. So just realize when your donor, if you put something in writing with a donor, or if you make a solicitation to a donor and they respond, you can be restricting these assets. And there's a way to lift restrictions. If your donor imposes the restrictions, they can lift them. So if I give money and say maintain it as an endowment, I can later say, you know what, I'm lifting that endowment spending restriction. You can spend it all now. But if the donor won't lift the restriction, or if the donor passes away, your options as a charity are much more limited. And it generally involves going to court and applying to the court and establishing that whatever the restriction on the asset is become unlawful, impracticable, or impossible to achieve, or wasteful. So something to be thoughtful of is if you're entering into gift agreements, if you're making solicitations, realize that you might be creating legal obligations on how you use those assets and when you can use those assets.
Thanks, Marisa. I will admit, other than knowing to check the FASB C958 box when a client is audited, it was not an area, or is not an area of focus. And interestingly enough, last week we were at a conference, a private foundation conference, and I asked several accountants about this just out of curiosity, and you could see their faces and be like, I wonder, I don't know which box I check. Do I check a box? So it's kind of fascinating. The only thing that sticks out in my mind is, I don't know if you recall, but prior to 2018, at least with the 2018 form, we had 3 categories. So there was the permanently restricted, temporarily restricted, and really the third bucket was assets that didn't fit into either category. So by default, were unrestricted. Then the standard came out and simplified things, at least in my mind. There's now 2 buckets, with or without. And I think in general in practice, see few donor restrictions with private foundations, unlike public charities that tend to have, set up endowments, but it's not uncommon. We definitely have larger private foundations that were at onset, restricted by the original donor. And that's something that they need to, work with and work through and make sure that they're, following the rules and have those assets restricted and follow the guidance. So it's very interesting from that perspective to me that it has many more legal implications, whereas for me it's, do we check the box? So with that, we're not going to obviously go through every detail of the form today. We just wanted to highlight specific sections. So the next area we're going to touch upon, and as many of you know, Part 3 and Part 4 and Part 5 are very specific tax calculations for the net investment income tax and realized gains. And so we'll skip to the more interesting section where there's a little bit more questions involved. And Part 6, there we go. Part 6A, line 2. There's a question: has the foundation engaged in any activities that have not previously been reported to the IRS? If yes, attach a detailed description of these activities. I myself haven't seen this come up too often. Certainly, I don't think I've ever had a client come forward and say, hey, I think we should check this box. We're doing X, Y, and Z that may be different from what we originally intended. Whereas where I have seen it is, an ongoing client that is, for example, starting to do some foreign activity, foreign granting, for example, that was not part of their original intent with the Form 1023. So with that kind of situation, like, is this what this question, I guess, is getting at from like a legal perspective? Or, is there like a level of what's material? How different can it be? Or is relying on the 1023 really, and anything that you're doing differently from what you've originally stated, really what this question is getting at? I'm just curious whether that's something that, you're only checking if you're doing something significantly different, or if some kind of periodic disclosures would be considered a good thing here.
Yeah, I try to tell my clients to make sure they tell their accountants when they're doing something new. And I'm afraid I kind of have bad news and I don't have a perfect solution. But, I think for a lot of people on this call, it's probably a moot point that when you apply to the IRS, originally, you really want to be as inclusive and as possible about what your contemplated activities are. And I'm not saying throw in the kitchen sink. At some point, it becomes meaningless. But what you say to the IRS in your exemption application is forever and ever what the IRS issued your letter based on. So when you have questions about, is this furthering your exempt purpose? Is this related to your activities? You're really setting the stage there. And so one piece of bad news, the IRS can always change its mind about how it's interpreting, what constitutes charitability. I mean, obviously that's subject to statutes. But Congress could change the tax code. They do a lot. So what qualifies today as a 501c3 purpose might not be something that qualifies in 10 years or 20 years, which is to say that like your organization, could have its exemption revoked if the IRS, changed something, if Congress changed the tax code. But the IRS cannot retroactively revoke an organization, meaning go back a few years, try to collect taxes for, income, so long as the organization's operating kind of, in material compliance with what they said in their original exemption application. So your exemption application is kind of your shield against any retroactive revocation. It's how you're going to make an argument that activities you want to do are related if they're kind of in the gray area. So if any of you are in a position to be filing a new 1023, I really encourage you to be kind of thoughtful and circumspect about it. I think there can often be like a lot of eagerness to apply because it's going to sit at the IRS for 9 months, and the earlier you get it in, the earlier you hear back. But it's an important document and you can't amend it. It's not like an income tax return where nobody wants to file an amended return, but it's possible, right? You've got a few years, you could go back. So this disclosure on the 990 is kind of like that's kind of like the next best thing. And so like if you are engaging in activities that weren't in your 1023, I would encourage you to at least tell the IRS. Then if the IRS, ever comes knocking, has questions, has concerns about whatever this new program is, whatever, if you're, to Maggie's point, if you're making grants overseas, that's something that's specifically asked about in the 1023. Like, are you going to have foreign activities? Are you going to engage in foreign grant making? So it's not to say that if you didn't put it in your 1023, you can't do it now. But the more you drift from what you originally said, the more potential exposure you have for the IRS to say, oh, you're not operating in compliance with what we granted your exemption for. As a practical matter, the IRS does not have enough resources to go hassle people that are doing C3 things, but just not the specific C3 things they said in their application. But I would still really encourage you to be thoughtful about how your programs have evolved and to tell your accountant so they know, like, yeah, we need to check the box and, let's disclose it to the IRS, because that's going to be a much better fact if you ever have to explain to the IRS what you're doing. If it's not in your exemption application, to at least be able to point to your 990 and say, we told you about it.
Thanks, Marisa. That is interesting. I think it comes up in the 990 setting a lot more, I would say, like in practice, especially since many, grant-making private foundations do grants. They tend to do similar grants every year. So I would venture to guess that for most private foundations, this isn't like a huge thing. But to your point, when you're starting off and, you may have your mission 10, 20, 30 years down the road, things may change significantly and you may be doing things very differently. So always good to evaluate that. And obviously one of the biggest critical pieces of the exemption is following your mission and what you were, what your tax exempt status is, hinges on that. So I think it's very important to be forthcoming. At least from my perspective, I always felt like there's really no over disclosing in a sense, because to your point, if the IRS were to come back, you could say, hey, we've disclosed this. It's always interesting to think about what on their end, how much are they analyzing that, right? Because if the box is checked yes, and you attach a statement, right? I'm always curious, does anyone read that statement, or is that just forever saved in some data file with the IRS? But nonetheless, it's there as proof that you did communicate it. And if they didn't raise any red flags at the time, I think that's at least somewhat of a defense if they were to come and, have any issues with your tax exempt status from that perspective. Okay, well, next section here, continuing with part 6A, but moving down the page, line 10 is, did any persons become substantial contributors during the tax year? If yes, attach a schedule listing their names and addresses. And this is another great question in this section, and this really starts to get a little bit more technical, as you will first off need to understand what a substantial contributor is. And we often assist clients in tracking disqualified persons, and a substantial contributor is a type of disqualified person. Again, getting more granular into the definitions. But a substantial contributor is someone who contributed or bequeathed more than $5,000 or 2% of total contributions from inception of the entity to date. I find that this affects newer private foundation clients more often, just because usually with private foundations, you have an influx, some kind of contribution to start, and then those private foundations typically continue on operating based on investment earnings or endowment. But that's not to say that you can't have contributions every year, and we do see that happen. And it might not be the same individual. And so we often emphasize to clients that it's important to track who these individuals are, retaining that in your records. As far as I'm concerned, if you are a disqualified person or a substantial contributor, you don't lose that title ever. So it's forever and ever. But Marisa, I'm just curious if you could further discuss the importance of knowing your disqualified persons and dovetailing to understanding a little bit more about that.
Yeah. So if you're a private foundation, and I saw a question in the chat about the difference between the 990 PF and 990. And so just to really quickly address this, which can dovetail into this response, the 990 is what other 501c organizations file, including 501c3s that are not private foundations, so your public charities. So kind of how that relates to this, if you're a private foundation, I don't think it's going to be news to all of you, but you've got a lot of rules that you have to comply with that don't apply to other type of 501c organizations, including other types of 501c3s. If a 501c3 organization is a public charity, meaning they're a church, a hospital, a school, or they have a broad donor base, or they have like a broad client base, they don't have to comply with what's Chapter 42. And there's no reason you need to remember that, but there's a whole chapter in the tax code specific to regulating private foundations. And those rules are kind of a pain. That's just a fact. And a big part of those rules, the reason private foundations have their own specific rules to play by is that other types of 501c organizations have more touch points with the public. Like your church has to have, congregants, your hospital needs patients. A private foundation is usually just looking to one family or one company or a really small donor base. So the thinking by Congress was that they could behave badly and nobody can do anything about it. So they need a lot more rules. And these rules are really key to, a big part of these rules is figuring out who your disqualified persons are. These rules include the self-dealing rules, which are rules that generally prohibit related party transactions. There's also the excess business holdings rules, which we're going to touch on more later. But complying with the private foundation rules requires knowing who all your disqualified people are. And your disqualified people include substantial contributors. And I think a really important thing to realize about your substantial contributors is, like Maggie said, like that status probably isn't going away. As a general matter, once somebody becomes a substantial contributor, they're always going to be a disqualified person. There is, in theory, a way that if somebody became a substantial contributor and then they don't make any contributions for 10 years and none of their family does for 10 years and what they gave was insignificant, there's a possibility to kind of have them shed that status and no longer be a disqualified person. I don't think that fact pattern is very likely. Usually with private foundations, we're dealing with a family, the family funded it, they're involved with it. So just realize, sometimes you're a disqualified person by virtue of being like an officer. And then once you're not an officer, you're not a disqualified person with respect to the private foundation. If you're a disqualified person by virtue of being a substantial contributor, you're going to probably forever be a substantial contributor and thus a disqualified person. And any people that are family as defined in the code are also going to be disqualified people. And that really affects who the foundation can have transactions with. It can affect what business holdings it can own. So it's a really important thing to keep track of. So if somebody becomes a substantial contributor, in addition to disclosing it on that 990 PF, like don't just write it down and then throw it away. You gotta really keep track of that person now. So it's becoming a substantial contributor really kind of affects permissible operations, and it's something you want to keep your eye on.
Thank you. And we typically assist many clients. The substantial contributors is easily tracked for us, especially if we work with a private foundation from inception. It gets a little bit tricky when you get a new client and then you ask them whether or not they've been keeping track, and they may have or may not have. And we have had several larger private foundations work with legal specifically through this. And since we've been talking about disqualified person and the different aspects of it, I will just, for the audience, kind of highlight what the definition of who disqualified persons are. And I recommend that you go to irs.gov and look up the definition. There's links within it to drill down into each category. But just high level, a disqualified person includes all foundation managers, all substantial contributors, an owner of 20% or more of an entity that is during the ownership a substantial contributor, a family member. And please note, with the family members, it would be your husband or wife, children, siblings are not included. So it's really just your direct lineage. And then a corporation, partnership, or a trust that any of the previously mentioned individuals, So foundation managers, substantial contributors, those owners of entities that may have been substantial contributors and their family members have 35% interest or more in it. So I think it gets very, very complicated, I guess, is the point of this definition, I think, and me mentioning it, is that it gets very complicated. And so I think it's important to know each category of the disqualified person and really understand that the list could be very, very long, depending especially how big your family is, right? And so it's critical to keep those people on a list, because as Marisa mentioned, there's a lot of rules, a lot of self-dealing rules, some of which really may not even make sense. But you don't want to be in a position where you've crossed the line and you have to report it and report self-dealing and file Form 4720. The one area of the disqualified persons, or the one subsection, the foundation managers, that's an area where I think I would say I struggle. Amy, why don't we do this polling question?
Sure. So the third polling question is, which of the following meet the definition of a disqualified person? And so the options are A, foundation manager, B, foundation president, C, substantial contributor, or D, all of the above.
I could test how many of you have been paying attention.
All right, we'll leave this up for another 5 seconds or so. And while you're getting in your last responses, I do want to remind you that we have the agenda located in the slide deck and handouts window, and it does have links to each of our presenters' bios, and that's available to download, so you can check that out. And here are the results.
Great. All of the above, about 83% of you. That's great. And I know that foundation manager, I know we have a number of questions in the Q&A, and I've let you know we're getting to that section, and the questions are about foundation manager. And I know that this can be tricky in determining a foundation, who is a foundation manager, and then also in terms of a foundation that has staff, that has officers that are staff, but then also your board officers. I know it can just be tricky for private foundations to determine that. So with that, Marisa, why don't we open it up with you to talk about who is a foundation manager?
Yeah. And just, I know Wendy's like speed responding to these questions, and it's amazing, but I saw somebody say, like, what is a disqualified person disqualified from? And that's a great question. And a disqualified person, as Maggie said, is this, it's a statutorily defined person with respect to a particular foundation. It's significant based on that foundation's activities, because in particular, there's the self-dealing rules applicable to private foundations, which are generally going to prohibit the foundation from having any sort of transaction with a disqualified person. There are exceptions to that, but your starting point under the self-dealing rules is a private foundation can't, rent property, make a loan, pay compensation to a disqualified person unless the transaction fits into an exception. So that's one of the significance of that status. A private foundation can't use its assets in a way that more than incidentally benefits a disqualified person. And then also we're going to touch more on, there's rules called the excess business holdings rules that disallow a foundation from owning certain portions of a business, and the permissible percentage is reduced by how much a disqualified person owns. So the disqualified person status affects the private foundation's compliance with the private foundation rules, and messing up, like a footfall under the self-dealing rules, even if it's not intentional, these aren't necessarily you were trying to act badly, you were, using your money in a bad way. But if you run afoul of these rules, there's penalty excise taxes that apply and you have to unwind it. So that's why knowing who your disqualified persons are is important, is so you don't inadvertently run afoul of these rules, because good intentions aren't always enough. So to the foundation manager, and I think there was a question saying, what's a manager? I always hear officer, and that's a great point. I don't think we usually, when we speak about foundations, I don't think we usually say foundation manager, because that's not the lingo in corporate law, right? We're used to directors, trustees, officers, and that is what the tax code then defines a manager as. So a foundation manager is a disqualified person if they're an officer, director, or trustee of the foundation, or have powers or responsibilities similar to those of officers, directors, or trustees. The regulations say that you're considered an officer of the foundation if it's specifically so designated in the foundation certificate or bylaws. So often bylaws have a section called officers, and they say, oh, our officers are our chair, our vice chair, our secretary, and our treasurer. So those people are going to be officers, which then makes them foundation managers and disqualified people. And so usually most people, I think, people on a board, if you're a trust and it's a trustee, if you're a corporation and there's a board, your board members, they're going to be disqualified people, and technically they're foundation managers who are then disqualified people. It can be a little more gray when it comes to which of your employees are foundation managers. And this definition of officer is like really very specific. So if you have an employee, their position's not listed in the bylaws, they're not on the board, they're not otherwise a disqualified person, but they regularly exercise authority to make administrative or policy decisions on behalf of the foundation, that person's going to be a foundation manager and thus a disqualified person. And you want to be, again, you really want to keep track of your disqualified people to make sure that you don't inadvertently run afoul of the self-dealing rules. But you also don't want to willy-nilly kind of lump a bunch of your employees into this definition, because these rules are constraining and you don't want to unnecessarily constrain yourself. And I think that which of your employees are an officer and thus a foundation manager is, I think, a little more limited than people sometimes think. They're making decisions on behalf of the foundation. So if you've got a chief operating officer that reports up to the CEO, I think there's really a question of, okay, is that person really an officer? They're not making the decision. They're reporting to the CEO, and the CEO is making the decision. So again, in these, you identify, the Form 990-PF kind of has charts where you list your officers, directors, or trustees and things like that. So just be thoughtful about where you put people on the 990-PF and who you're signaling you think is a disqualified person.
Yeah, that's very interesting, because I think in general, from the accounting perspective, we tend to be more conservative. At least that's been my practical experience, where we'll pick up the board and, anyone who we consider an officer, director, trustee. But I know we've had various private foundation clients who've worked with legal because they really needed to drill down to who out of their pool. And, I'm sure many of you know the titles and the roles between each private foundation differ, right? So assuming one, finance director's role is the same as the other finance director's role, we can't assume that. But we tend to, I think, be more conservative with this. And the one thing I wanted to mention is that we've had clients work with legal on fine-tuning those definitions, particularly the foundation managers. And through that process, eliminated quite a few folks from the list. So if any of you are unsure or aren't really clear on who within your organization fits these definitions, I highly encourage you to work with legal and really get a solid foundation for who you should be capturing. Of course, more is better than less, but I think it's important to know exactly and not necessarily be tripped up by people who shouldn't be on this list in the first place. So Thank you for that. And then I saw a question in the chat about the 5% or $5,000 versus 2% for disqualified or for the substantial contributors. And so it's at the minimum you have to contribute $5,000 to be a substantial contributor. But if your $5,000 is not 2% or more of total contributions, then you wouldn't be listed. You get eliminated, if that makes sense. So initially in the inception of the private foundation, you tend to analyze everybody, or if there's one big donor, right, by default, they're a substantial contributor. It's over the years that number, especially if there's contributions each year, that number sort of keeps growing what the 2% is and that threshold. So in theory, that threshold continues to grow over time, and it's harder and harder to become a substantial contributor, but not, of course, impossible. So we are nearing, we covered that, and I think we have another polling question, Amy.
All right, so the last polling question for this presentation is: a private foundation's interest in an investment cannot exceed, and your options are 2%, 20%, 35%, or it depends. And then for those of you that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. We are also sending them out via email after the conference, along with the recording of the session. All right, here are the results.
Great, thanks, Amy. It depends, almost 59%. That's a great answer, because any of the top three, 2%, 20%, or 35%, could be accurate. It really just depends on the fact situation. This is a really complex area, and I do want to acknowledge, I know we have a number of follow-up questions in the Q&A on disqualified persons and family members, but I also know that Maggie and Marisa do want to make sure they get to the excess business holdings section. So we're going to continue forward with that. If we're able to answer in the chat or in the Q&A through the chat, we will do that. But I want to give them time to talk about excess business holdings before we close this out. So with that, Maggie and Marisa, if you could speak to the question specifically in part 6 and the excess business holding rules, that would be helpful.
Thank you, Wendy. So part 6B, lines 3A and 3B. So 3A asks the question: did the foundation hold more than 2% direct or indirect interest in any business enterprise at any time during the year? 3B applies only if you answer 3A yes, and it has a few subcategories. So they want to understand if you had excess business holdings as a result of purchase by the foundation of disqualified persons after 1969, a lapse of a 5-year period to dispose of holdings acquired by gift or bequest, or the lapse of the 10, 15, or 20-year first phase holding period. And so for those who don't really know the history of investments and how in the interaction with private foundations. So in 1969, there was a huge tax reform, and that's where a lot of these private foundation rules came about. That's where they felt that there was a lot of abuse, especially in the private foundation realm. Many of it was publicized. Certain larger private foundations were, definitely criticized in the media. But they came up with this rule, and of course, they didn't expect private foundations to shed their investments and adhere to this rule in an instant. So there was a different phases for shedding of those investments. And so interestingly enough, I learned that in the 70s and 80s, because of the implementation of this rule, there was actually like a mass sale of stocks and corporate investments as a result of that. A lot of it was shed by private foundations. And so I think I personally don't work with any clients who, still have investments that date back to 69 that they may have not disposed of. Where I see this come up is in the context of alternative investments and really an investment portfolio. And so for a private foundation. So we typically, when we analyze investments and look into them, pay attention. Is it 2% or less? If it's 2% or less, it makes it fairly easy, both from the perspective of this question and any excess business holdings impacts, and also really with respect to unrelated business income, because as many of you know, if it's 2% or less, it's considered de minimis, and that you really don't have to worry about it. That investment, you don't have to do further due diligence to figure out if it's really a business enterprise or not. And you also, for purposes of unrelated business income, it's a qualified partnership investment, for example. When it's more than 2%, that's when we pause and we look a little bit deeper. So we often, since we have the information for the foundation, what they're invested in, we try to figure out, is this a business enterprise? And this, again, gets at the fine definitions of what a business enterprise is. And so it does have to be an active trade or business. And for example, if you invest in a real estate partnership that just has passive rental income, and that's what that partnership does, it will likely never, be a business enterprise by definition or rise to that level. But it gets really tricky, and we often rely on investment managers or the private foundation to give us a little bit more information, because that's not really the end, right? You also have to know what the disqualified persons own, and all these other different pieces. And so just curious, Marisa, from your perspective with the excess business holding rules, how often this comes up, and how good are your clients at actually having all the details?
Yeah, this is most of the private foundation rules are pretty thorny. I would say the excess business holdings rules are some of the thorniest. And I think some organizations avoid them altogether. But I think there's a lot of confusion here. Again, being a private foundation, you have to play by additional rules than public charities. So I think that can cause confusion, because a public charity could have a wholly owned for-profit subsidiary. And under the excess business holdings rules, a private foundation really can't. The excess business holdings rules also apply to a sole proprietorship, which means essentially activities the foundation itself does. So if the foundation's engaging in an active trade or business that's unrelated, that can be kind of a deemed excess business holding just by virtue of the activities, even though there's not a separate entity there. But what these rules are effectively doing is we don't want Congress didn't want private foundations engaging in unrelated trade or business activities, and also is generally prohibiting them from owning a significant portion of a quote unquote business enterprise. So as Maggie mentioned, if what the business is kind of like a passive holding company, it's just getting most of its income is, dividends, interest, rents, royalties, that's not a business enterprise. It could own all of that. But once you have an active business, as the foundation can own up to 2%, regardless of who else owns it. But once you're above that 2% de minimis threshold, this is when you have to know, what do all your disqualified persons own? So again, this is one of the reasons you care about who those people are. And the foundation's generally not allowed to own more than 20%, with that 20% reduced by how much disqualified persons own. And so the fact pattern I see come up is, a lot of people that have sufficient wealth to form a foundation own a closely held business, and they want to fund their foundation with the stock of the business, or they own the business and they've put in their estate plan, I'm going to give all of my business stock to the foundation when I die. Like, everything's going to the foundation. And now you have a foundation that holds a business, and maybe it's all of the business. Maybe that was a very generous estate plan. There's a 5-year grace period for a foundation to dispose of a business holdings in a business enterprise that it acquired other than by purchase. So if it gets it as a gift, as it gets it as a bequest, it's not automatically going to run afoul of these rules. But you can't always dispose of closely held business in a short period of time. You can go to the IRS and ask for an additional 5 years if you're having trouble meeting that initial 5-year period. And so that's the setting I see it in a lot, is the estate plan. Or the other thing is, again, these closely held businesses, these family businesses, if the older generation is willing to part with some of the stock, wants to give it to the foundation, and then the rest of the stock is going to the children are probably going to be disqualified people, right? So this is back to if the founder of the business also founded the foundation, they're probably a substantial contributor. And now all of their children are also disqualified people. And so the foundation isn't going to be in a position, like, even if it was just a 10% interest in the business, if the other 90% is held by children of a substantial contributor, it can't own that. It can only own up to the 2%. Because the rest of the business is owned by disqualified people. So, this doesn't necessarily come up a lot, but I think it comes up a lot for people that have made their money through a closely held business and then want to use that stock as a planning tool and to fund their philanthropy. And this can, prove challenging. If they've done it in their estate plan and aren't familiar with these rules, this can be a really unpleasant surprise when the foundation's going to have to dispose of this presumably income-producing asset. Or in the alternative investment space. So one of the exceptions to a business enterprise is a program-related investment. So if you're investing in a business for programmatic reasons, you can avoid these rules. That's the subject of a whole nother panel, but it's a very high threshold to be holding a private company and claiming that it's not primarily for investment purposes, but primarily to further charitable purposes. And so it is a possibility, but not something that can be done kind of nonchalantly. It's got to be pretty deliberate and well documented.
Yeah, and I think the one thing that came to my mind that we have not mentioned here, and we often, when we discuss this with clients, we have this handy chart with the 2%, 20%, and the 35%. And recently added the 100%, right? The Newman's Own exception. And I think that's a great example of a family business that was 100% of the business was put into the private foundation. They did not dispose of it in their initial 5-year. They asked for more time. And I think, I'm not exactly sure on timing, but I think within their 10-year period is when the Newman's Own rule came into play. And, they allowed them to keep the Newman's Own business and created this special rule that you can own 100% of a business. There are very, very specific facts and circumstances, of course, and how to make that happen. But I honestly, it's still something, even though this passed in 2018, I believe, it's still interesting to me that I don't see many private foundations taking advantage of it. And obviously that's probably more of, to your point, like an estate planning, right? Kind of situation, sort of like it was with Newman's Own. But I'd just be curious to see over time if that kind of gets utilized a little bit more, especially as, I've heard a lot of the newer generation, particularly people that don't have children, may want to leave some legacy, and private foundations are a great vehicle to do that, especially if you, restrict your assets, for example, put in your entire business and have that go on in perpetuity in theory. But just curious Marisa, have you had any clients take advantage of the Newman's Own exception, just out of curiosity?
No, that's a great question. I think the rub with the Newman's Own, and when we say Newman's Own, we're actually talking about that brand, right? The salad dressing, you can picture Paul Newman's face. They wanted the foundation to be able to own it, and it wasn't like the entirety of the business, and it wasn't going to be possible under the excess business holdings rules. And so there was an exception that was like passed in, like implemented into the tax code. Everybody kind of colloquially refers to it as Newman's Own because it's very well known that it was very specifically so that that foundation could continue to own that business. And I think the rub there is that there's got to be independent operation of the business. So when you have a family business and you want to give it to the foundation, that's where I've always seen it break down with my clients is the directors and officers of the business, you can't have a majority overlap with the private foundation. And I think there's also, it's that independent. There's a provision in the Newman's Own where you're bifurcating that essentially the foundation gets the economic beneficial interests of the business, like they're going to get the non-voting stock, they can get the dividends, but then the business is being run independently from the foundation and I think from the family. And so that's where I've never had a family willing to move forward because of that kind of like, you know, it's a very specific set of circumstances. And usually when I see with a family business, it's they don't want to have the foundation not have control. They usually want the same people kind of overseeing the philanthropy and overseeing the business. And then that's where that exception no longer is appealing.
Thank you.
And
No,
Marisa,
that's really interesting. Yeah. And sorry to interrupt, Wendy, but I just, yeah, it'll be interesting to see what happens or if it really Newman's Own just got their own, right?
They get their own tax code provision.
No, I was just going to echo what Marisa said, that I think in our experience, it's been the same rub. It's been that same provision that's caused a pause on moving forward with the Newman's Own exception. We did have one additional question in the Q&A that I think is pretty quick, and I know we only have 3 minutes, but can a trustee also be the manager of the foundation? And what is the difference between a director and a trustee?
Yeah, I can field that. So the definition of a foundation manager is a definition in the tax code that includes officers, directors, or trustees. Most people don't use that language, you know, colloquially, but that's a, you know, it's a term of art for the tax code about somebody that's a disqualified person. So usually your trustees are going to be foundation managers for purposes of the private foundation rules. The difference between a director and a trustee isn't necessarily obvious. So if you have a C3 organization formed as a trust, the people legally responsible for operating it are the trustees. If you have a C3 organization that's a nonprofit corporation, that nonprofit's going to be governed by a board. Almost, I think all nonprofit corporation acts refer to the board responsible for governing a nonprofit corporation as a board of directors, at least in the statute. But lots of organizations refer to their board as a board of trustees. So then it gets really confusing because they refer to the people that are their board members as trustees, but the entity is not a trust. They are technically not trustees. They are board members, but they are referring to their board members as trustees. So if somebody's saying director or trustee, and you want to know, well, are you just talking about a board member, or are you actually talking about a legal entity that's a trust and this person is a trustee? You're just going to have to ask because people are not always precise in using those. And so nonprofit corporations often adopt this kind of board of trustees, trustee lingo, even though technically it's a board of directors and their board members are directors within the meaning of the Nonprofit Act.
Great. I'm glad you took that question. That's a great explanation. Thank you. With that, I think, Maggie, did you have anything else that you wanted to say before we close it out?
Nope, that is it. Thank you.
And Marisa, any closing thoughts?
No, thanks for being such an engaged audience. It was fun to get so many questions. There's people out there.
Great. Well, thank you both, and I'll turn it over to Amy to close us out.
All right. Thank you all for a great discussion. And we are going to take a 5-minute break and then regroup for our next session, which is 501c4, Rules, Guidance, and Opportunities. Please keep your webcast console open and join us back here in 5 minutes. Thank you.
All right, everyone, we're going to go ahead and get started again. I hope everyone enjoyed that first session of the morning and is feeling refreshed from the break. And now I will turn it over to Lauren Haverlock, tax partner with Moss Adams, for our next session, 501c4 rules, guidance, and opportunities.
Hello, everyone, and welcome. Hopefully my mic is working and I've gotten everything unmuted and off video. I'm excited to present today about 501c4 organizations. Before we jump into it, I'm going to let the team here introduce themselves really quickly. I know you all saw me enough yesterday, but I'm a tax partner here at Moss Adams. I work in the tax exempt space with foundations and nonprofits of all different types. And I'm going to send it along to Diara to introduce herself.
Great. Thank you so much, Lauren. And thank you to Moss Adams. It's a real pleasure to be here. I'm dialing in from a client's conference room, hiding in a corner. So thanks for including me. I'm Diara Holmes. I'm co-chair of Loeb and Loeb's nonprofit and tax exempt organizations practice. I am based, and I'll turn it over to Kim.
Hi, thanks, Diara and Lauren. I'm Kim Eney. I am also a partner in Loeb's tax exempt organizations practice. And I'm happy to be here. Thanks for the invitation.
Awesome. And these individuals with me are some giants in the nonprofit area and the 501c4 space specifically. So I'm excited to present with them. You all might be asking, I know that our attendees here are all types of foundations, community foundations, private foundations, some practitioners. You might be wondering why we're stepping outside of the charitable world today and leaning a little bit more into the tax exempt space on a more broad level. But really, social welfare organizations, 501c4 organizations are really having their moment in the sun recently. And these types of entities have existed for many years, but they've been a little bit more prevalent in the recent years, connected into the charitable world, although they're not charitable organizations. They've been a little more connected in the charitable world in ways that help achieve a philanthropic vision for founders and for organizations and for nonprofits. I think a lot of people may have heard a little bit about the recent news with Patagonia, and I think it was at some point last year, about a year ago, where Patagonia and its founder, Yvon Chouinard, announced that their company was going for purpose, and much of all of the profits that were connected into into Patagonia were going to be given essentially to a 501c4 organization, and that the company was going to be owned essentially by the earth. That's going to be their one shareholder. That's not the first time this has happened. There's been some other examples. I think Triplight was a prior one where the owner of the organization Triplight put their company into the Marble Freedom Trust, which was an already existing 501c4 organization. And then I think there's been a couple other announcements, like Hobby Lobby had something similar. So it's been in the news recently that some of these large organizations have become kind of switched over to have a nonprofit type ownership. So we do suspect there are more to come, but just to level set a little bit with that background. This session is going to explain a little bit about what a 501c4 organization is, overviews and tax considerations to demystify this type of nonprofit organization. We're going to talk a little bit about the tax characteristics of the organization itself and those who fund it. So what happens when money goes into a 501c4 organization? How does that impact the owner of the owner of the organization or the funds that are going in? Sorry, my dog's decided to bark. And then we're going to talk a little bit about the political activities and lobbying characteristics that are permitted in the 501c4 structure. Integrating C4 into a philanthropic vision is something else we're gonna discuss a little bit. So if you are an existing private foundation, public charity, and a C4 sounds interesting to you and something that can help your organization achieve its philanthropic vision, we'll talk a little bit about how C4 operations, activities, organizations can integrate into your structure. So whether it's creating a C4 to operate side by side with your organization, grant making to C4s or receiving funding from C4s, that's going to be something that we'll hit a little bit upon. And then just a little bit of information about how is it created? How does a C4 come about? So that's our agenda. Anything else to add before we dive into the details? Nope. All right. Well, we'll go straight on to the polling questions that we have.
Oh, that
Amy,
sounds great. Thanks, Lauren.
Oh. Amy, do you want to take it away with polling?
Sure. So the first polling question for this session is, what do you think of when you hear the term 501c4? And your options are A, dark money, B, social welfare, C, saving the planet, D, philanthropic planning opportunity, or E, nothing, never heard of it. And then as a reminder, please click the button next to the answer you choose and make sure to hit that submit button so that it registers. And then for this session, oh, sorry.
Go ahead, Amy.
Go ahead, Lauren.
No. You have housekeeping. Take it away.
I just wanted to remind everyone, you do need to respond to at least 3 of the 4 polling questions that we pull up throughout this presentation.
Yeah, and I'm interested to hear what everyone thinks about the C4 organization. I think we have a different perspective of it working in the charitable and nonprofit and tax-exempt area, but you might have a different perspective in hearing news or from your experiences, especially if you're on the foundation side of things. Do we have the results, or are we waiting on some more?
It looks like enough have responded. Here are the results.
All right. Well, that's good to see that only 10% think of dark money. That's a positive update here. We'll talk a little bit about why that perception even exists in the first place when we get into the lobbying and political activity space and talk through that area. But really what we'll start with right now is that broad overview of what a C4 organization is. As we go through, please feel free to ask any questions. We'll try to address them here, but we want to make this content relevant to those that are participating. All right, so a 501c4 organization, we said social welfare, but this type of entity is a tax-exempt organization that must operate exclusively for the promotion of social welfare. That exclusive definition is comparable to what we see in the 501c3 space, which is essentially a large portion, maybe about 90-ish% or so. There's no definite number must achieve before achieving a social welfare purpose. The entity must not be operated for profit or organized for profit. And that doesn't mean that it can't achieve a profit, can't be profitable, but what it means is that there can't be any sort of shareholders or owners to that organization. And that's achieved in the structuring of that entity and the articles of organization, the bylaws, etc. None of its earnings can inure or benefit a private shareholder or individual. And that factors into that not operating for profit. Sometimes, we will see that organizations, while they might not have an owner, there might be compensation structures that look a little bit like private inurement or private benefit to a particular individual, where that person is benefiting from the profits of that organization. And essentially, the rules for a C4 organization are consistent with what we see for 501c3 public charities, that there can't be any sort of private inurement or private benefit in this space. One of the more interesting features of the C4 is that in order to achieve social welfare purposes, organizations that operate under this code section are able to do unlimited lobbying activities. And that can be a C4's primary activity. It can be all that they do. They can lobby, and we'll clarify more later on, but lobbying is something for or against legislation, or so promoting, legislation one way or another. It's not political activities, which is on the next slide. Those are permissible. So political activities are support for or against a candidate for office. But a C4 can do that. They can undertake political activities, but it can't be their primary activity. They can't be a social club. So if you're thinking about a fraternity or a country club or something to that effect, you know, a tuna club or things of that nature. That's not a C4 purpose. And it can't operate a business that's comparable to something that's undertaken on a for-profit level. So, you know, I would kind of equate this like if you want to operate a gym as a 501c4 organization, thinking that health and welfare is good for the community, but you're operating it like a 24-hour fitness, that might look a little bit too much like a commercial activity. So there's a little bit more privacy for donors in the C4 space because of disclosures on the Form 990 itself. There is no requirement to disclose to the IRS those donors, unlike any other type of nonprofit organization, and also different from a PAC that is required to include its donors on there. And so, yeah, those are some of the characteristics and some of the, I guess, opportunities that you have with the C4 organization. And you might be saying at this point, like, that sounds amazing. It sounds like a great type of entity. I want to know more what social welfare means, which we'll get into in just a second. But what's the catch? And the catch really comes down to there are no charitable tax deductions for donors. So a donor that gives to a 501c4 organization is not permitted to take a charitable contribution deduction. So that's the catch. No charitable assets within the organization and no charitable deduction for donors. All right, I'm just pausing for a second. I know it sounds like Diara has a little bit of a lag, so I want to make sure she has a chance to get in any comments that she has, but feel free to jump in if I missed anything, Diara and Kim. All right, well, what is social welfare? I think that is the big question that we have, and really, social welfare, the definition is something that benefits society as a whole. There needs to be some benefit to the common good and to the general welfare of people in the community. The real catch here is that this social welfare purpose can't really be limited to a small group of individuals. It can't be restricted to too small of a group of individuals. In terms of what is social welfare, it's really anything that's charitable with a little bit of an additional permission, so additional lobbying allowed, and kind of an expanded definition of how society is benefited outside of what we see in the charitable world, which has limitations to religious, charitable, scientific, testing for public safety, educational, prevention of cruelty to animals. Those are kind of those defined charitable purposes, but social welfare can be a little bit more. The things that we might see is anything that's like maintaining a public space. So if you're an organization that wants to maintain trails or put in parks, you want to provide public housing or create a community newspaper or preserve the traditions of a community, those are all considered social welfare purposes, while they might not necessarily hit that charitable purpose element. So there's a little bit more that you can do, but you can do anything charitable. So it's anything a charitable organization can do, a C4 can do, and then some. Some of the kind of questions is that the community isn't defined. So it could be a segment of individuals, but it can't be really restrictive, and it can't be too small of a group of individuals. Some popular types of C4s that are out there. One is a homeowner association. Some homeowner associations are C4 entities, but where that would be a problem is if your HOA is really for restricted benefit. Like if you have a gate in your community and your HOA is only benefiting that gated community and no one else can access it, the public can access it, that wouldn't meet those social welfare purposes, because while your community might benefit, it's restricted. Additionally, that should be the organization's primary operations. So there can be other types of operations. There can be unrelated business activities, but it would have to be incidental to that primary activity of common good and social welfare. Do y'all have any other thoughts on social welfare that I didn't address here? I know there's a lot. There's a lot. There's actually not a lot. It's actually kind of broad in terms of the definition, but do you have any experiences in terms of what can help align what a social welfare purpose is for those on the call?
I think you've covered it. I think your heading is actually perfect. It's sort of anything that a C3 can do, a C4 can do, no question. And then there's just this plus zone. So while you may, for example, not have a curriculum and consider yourself educational in the sense of a school, you might be advancing education, big picture, by somehow supporting workforce development or certification programs or something like that. And so that's one example I see a lot in the education space. I see advancing or promoting education, but not necessarily a teaching or a type of activity which might qualify as a C3. We see it a lot in the sort of building movement space where, as you indicated, lobbying is the social welfare, changing the law for one reason or another, whether it's for the earth, whether it's to end domestic violence, whether it's gun violence prevention. If your purpose is to change the law, you'll be an action organization if you're a C3 and you won't qualify, but you'll qualify quite readily as a C4 if that's your absolute purpose. So I think you covered it.
Yeah, and it's also interesting because the regulations under Section 501c3 do also refer to social welfare purposes, but they're more narrowly defined and they focus on organizations designed to lessen neighborhood tensions, combat community deterioration, eliminate prejudice and discrimination. And so again, to both of your points around this 501c3 plus, it's certainly a concept that's embedded within the 501c3 framework, but 501c4 certainly encompasses a broader range of activities, which is very helpful.
Yeah. Mm-hmm. And I've had clients ask, like, what isn't social welfare? One of our organizations, their thought is philanthropy is kind of going one way. We see things a different way. We see a different way to solve, issues of houselessness that aren't kind of where we see philanthropy going. Is that social welfare? And I think as long as you can define a benefit in terms of, what is the benefit to that larger community and what is that community, and that it's not just specifically inuring certain individuals or benefiting certain individuals, that's going to meet that purpose. And part of that goes into like your application with the IRS and what are you defining your activities to them. They're not really a judge of like what is the right thing to do in housing, or how is the right way to create a community, or what's the right solution to food insecurity. They're wanting organizations that tackle that in some way to make society as a whole better. So that's something I think has got a little more flexibility in the social welfare area. Some of the historic uses, and I use historic kind of with a little bit of a jest, because this is just what we've seen more in the C4 space until recent years, where we've seen this as part of a philanthropic planning for, certain, families and individuals and businesses. But historically, C4s have been lobbying and advocacy organizations, employee associations, civic leagues, airport operations, parks, community associations, health plans. These are the typical types of C4 that we've seen in the past that don't really fit neatly into the C3 charitable space, but are operating in a social welfare space. So what are the tax considerations? We already talked about, that for a C4 organization, it's not charitable. A donor doesn't get a charitable deduction for putting assets or cash into a 501c4 organization. But a lot of times with a donor, that's not their primary goal. A lot of news out there lately has been that some of the wealthiest individuals don't pay any income tax. And that's because a lot of their wealth is tied up in assets and businesses that aren't providing them cash flow that is taxable to them. So for those individuals, or for people that don't have that type of income flowing through, but maybe have a large portfolio of appreciated assets and businesses, charitable deduction might not be their primary motivator. It's not eligible. So, but that's okay for some individuals. It does if you're properly, and all this is, broadly speaking, there's ways, that you can trip this up and have a gift or have estate tax issues. But broadly speaking, a gift to a C4 organization is not eligible for gift tax. So you don't have, that doesn't hit that individual's lifetime exclusion for gifts. And so I don't know what that is. I don't practice in that space, but it wouldn't count towards that individual's lifetime gift exclusion, and it wouldn't be eligible for gift tax, wouldn't be taxed on that as a gift. And then we noted here that estate tax is not a contribution to a C4. We say that it's not exempt, but I think in certain situations where you're giving assets to a C4 organization, it can be considered to come out of the estate of the donor that gives that contribution to the C4. There's a lot of planning and a lot of care that goes into this consideration of estate tax. So this is something that we'd always say, consult with attorneys or professionals in this area. But there might be ways that you're able to get assets out of an estate by putting it into a C4 organization that's not controlled by the giftor of that. Grants from private foundations. So if you're a private foundation thinking, can I give to a 501c4 organization? I can give to C3 organizations. Giving to a C4 organization would be giving to a non-qualified tax-exempt entity, and you'd have to exercise expenditure responsibility on that gift, just as you would if you were giving to a for-profit or a foreign organization, just to ensure that that gift is used for charitable purposes. And we'll talk a little bit more about that and what that looks like in later slides, but that's just consideration for private foundations. So with that, we've gotten to our next polling question. Does the lack of a, oh, sorry, Amy, you can take that away.
Okay, I'll give you a break here. The second poll is, does the lack of a charitable deduction for contributions to a 501c4 eliminate this vehicle as a viable option for your philanthropic planning? And your options are yes, that reduction in income tax liability is vital. B, no, I'm more concerned about my estate tax. Or C, it might be something we can work around.
All right, and while you all answer that poll, just so we give you a little bit more time, I'll just continue on. Sorry, I have to put my phone on silent as well. I'll just continue on with the slides here. Entity level tax considerations for the organization. So when you have a C4, and I won't move the slide forward until the poll results come out, but the next slide, just to give you a preview, talks a little bit about what does that C4 organization itself have to consider with its taxes. So it's still subject to unrelated business income the same way a 501c3 organization is subject to unrelated business income. So any sort of revenue generating activity that it has that's not related to exempt purpose, you know, if that organization holds debt financed assets that are producing investment income, that would be taxable just like it would be to a C3 organization or a foundation. So that's the same. You can't escape that UBI tax. Generally speaking, though, passive activity is not subject to income tax. So if you do have an organization that a C4 is used, maybe that as an alternative to a private foundation, you want to drop an asset or a business into a C4 organization and that business produces dividends, those dividends from that business would be generally not subject to income tax. It would be free from tax because it's passive. That dividend is passive, although there's an active business underneath, that dividend is passive. Are we able to move the polling results? Interesting. Great. All right.
Let's see. Oh, I like the open-mindedness in that it might be something we can work around.
Very cool. All right. So this is just the slide that walks through UBI. So it would be, depending on the structure of the organization, it might be a corporate tax rate, or if you're organized as a trust, a C4 that's organized as a trust, your UBI would be taxed at the trust rates. There are taxes on excess benefit transactions. So while a 501c4 organization doesn't have the same restrictions that a private foundation might have in terms of self-dealing essentially restricts any sort of transactions with the organization and a disqualified person. The transactions with disqualified persons are permitted permissible for or permitted with a 501c4 organization, although it's kind of like a proceed with caution, right? Any transaction would need to be undertaken at a fair market value. So if you drop an asset into a 501c4 and then you want that back, you would have to buy it back at an established fair market value. There might be other things to consider in doing that. You know, how does it impact your estate? What kind of step-up issues might there be? But when it comes to looking at that C4 itself, it would need to get fair market value for that asset. Can pay compensation. Again, it needs to be reasonable compensation for services provided. Should have expenditure or expense reimbursement policies. It can't reimburse personal expenses. All those things that a private foundation and would have to consider on the comp area, or public charity on the comp area, a C4 would have to consider as well. And then, like we mentioned, there is no Schedule B reporting of donor information to the IRS and to the public as well. So for private foundations, Schedule B information is available publicly, not for a C4 organization. The name and address of the donor would be redacted. As we alluded to, you know, one of the considerations when maybe using a C4 as part of a philanthropic vision of a family or a business, the private foundation excise taxes do not apply. So there is no tax on net investment income. There are no self-dealing rules. Arm's length standard, like we just talked about, would be required. No minimum distribution requirement. A lot of times we get the question of what does a C4 need to distribute within a year? What does a C4 need to do within a year? There's no guidance. That C4 just needs to have operations for social welfare purposes. So you can't put an asset into a C4 and do nothing. You would need to do something, but there is no set standard as to what percentage that needs to be of your assets. It's not like a 5% standard or something, but you need to have some social welfare purpose and activities. The excess business holding rules do not apply here. So you can hold 100% of a business or a operating asset and not worry about that. And no taxable expenditure limitations. You can grant to foreign organizations or for-profits. You can do PRIs. You can give to grants and scholarships to individuals. None of it needs taxable expenditure. Well, but just before that, before you think about, okay, they can just do whatever they want to, we probably would still recommend you use some sort of procedure like the taxable expenditure rules have to maintain that the grants that you're giving out are for a social welfare purpose, but you don't have those stringent requirements there. And with that, we have this really neat comparison chart, and I'll pass it along to Kim. I feel like I've talked way too long, so I'm sorry about that. It always goes way quicker than you think to talk through
it's great. Thanks so much, Lauren. And it's very helpful, a great lead into this chart. And I don't think I need to spend tons of time on it because Lauren highlighted some of the key distinctions so well. Generally, you know, private foundations, charities, DAFs, they're all in the 501c3 world. And one of the main advantages, as Lauren noted, of the 501c3 world is that contributions are eligible for the charitable contribution deduction. So when we're looking at donors that don't have that interest or need or have, you know, additional interests in lobbying or campaign activities, then the C4 becomes a more viable option. Similarly, for foundations, and thinking about interactions with C4s, Lauren pointed to the expenditure responsibility rules. And so if a foundation is comfortable in exercising expenditure responsibility, it makes expenditure responsibility grants, then interactions and funding 501c4s might be a more comfortable place to be than others that don't have that experience or familiarity. But certainly 501c4s do offer a number of tax advantages, particularly as compared to private foundations. 501c4s aren't subject to all of those private foundation excise taxes. And so they're very helpful from that perspective. And as compared to charities, which also aren't subject to those private foundation rules, the fact that they can engage in more lobbying than charities and some political activities means that at times, particularly when you're looking at an organization or wanting to support activities that do involve more lobbying, then the 501c4 becomes a more viable option. But certainly there's plenty that can be done at the foundation level with C3s on the lobbying space. Certainly there's the prohibition for foundations, but some grant making can be made to charities that lobby under certain circumstances. So, and we'll talk a little bit more about that in a couple of slides.
Great. So I'll discuss intermediate sanctions briefly. I think Lauren pretty much covered the most important thing, which is that distinguishing Section 4958 from Section 4941, which our foundation clients are used to dealing with, it feels a little bit like a relief, because instead of us saying no, just as a default, no, you can't have any transactions between the charitable organization and its insiders called disqualified persons. When we're talking about a C4 organization, we live under the same rules as public charities, not private foundations, which is to say there is flexibility to do, most of the time I see leases, I see license agreements with royalty streams, I see executive comp, of course, different transactions, sometimes sale of property and assets, sometimes, most of the time, rent and royalties are what I see. But in any event, you identify who your disqualified persons are from the beginning, from formation and periodically thereafter, so that you can be on the lookout and apply your policies with respect to, it's usually the compliance with the 4958 standards sort of lives in a conflict of interest policy, but it could also live in its own standalone policy. But you need to know who your disqualified persons are at the entity level in order to implement that. And then, of course, for annual 990 filings, you've got to know who your disqualified persons are in order to determine whether you've got any disclosures to make on Schedule L. And then, of course, if you do have an excess benefit transaction, either committed or discovered during that tax year, you might have a 4720 or two to file. Oh, let me see, do I turn it? Oh, sorry. So who is a disqualified person? I think if you're familiar with the 4941 rules in the self-dealing context for private foundations, none of these will be terribly surprising categories. But the definition, big picture in the regulations, is anyone who exercised substantial influence over the affairs of the organization at any time during the 5-year period ending on that transaction. So what does that mean? It means there's a 5-year look back period. So if I'm the former president of the university, I should not be living rent-free in university housing in any of the 5 years after well, really ever, but I still count as a disqualified person for the 5 years after I leave office. And so a below market loan to me or free rent or anything of that nature will end up being disclosable and evaluated as a potential excess benefit transaction for 5 years. So it's not just while you're on the board, but you're presumed to still have substantial influence even when you're emeritus and have resigned for a while. So it's also persons having substantial influence per se. That would be voting members of the board. It would be the president, CEO, COO, CFO, treasurer. You can't get away. Lots of clients try to sort of wordsmith and say, well, I'm not really a disqualified person because I'm the director of operations, not the chief operations officer. Well, if you're functioning like a COO, you're a disqualified person with respect to that charity, or in this case, C4. There's also a facts and circumstances test, right? Kim and I get calls all the time to sort of double click and deep dive with the client about whether a particular position is the chief nursing officer who may have substantial hiring and firing authority in a hospital context. Is that person a disqualified person? Those kinds of things come up periodically. So another category of disqualified person is, as in the self-dealing context, family members of the foregoing, and 35% controlled entities of disqualified persons are themselves disqualified persons. This comes up all the time in the family office context. I'm sure there's plenty of you out there nodding. But again, it's a much better outcome. It's a much better conversation than the 4941 disqualified person context where I'm telling you, no, the family office, LLC, C Corp, whatever it may be, can have 0 transactions back and forth with the family foundation. Here, in the C4 context, there can be transactions, but you're going to need to do some careful documentation and the benchmarking that's required to make sure that those transactions are fair market value. Okay, turning it over to Kim.
Great, thank you. So we talked, or Diara just mentioned one of the ways that 501c4s are like 501c3 charities. And now I'm going to talk about one way that 501c4s are a little bit different from 501c3 charities. And it's really one of the main advantages of forming a 501c4. And many charities oftentimes form related 501c4s because they can have a relationship with an entity that can do more than what the charity can do, particularly around lobbying. And so we find this all the time, and a lot of private foundation funders may also find applications that are coming from 501c3s with related 501c4 entities. And sometimes 501c3s themselves aren't aware of private foundation obligations, particularly in connection with expenditure responsibility or the prohibition on lobbying, and sometimes get confused around what the appropriate grantee entity is and what the appropriate activities of the grant should be in light of the foundation's obligations and its prohibitions on lobbying, as well as campaign activity. So 501c4s are very helpful because unlike charities, which are subject to this prohibition around engaging in substantial lobbying, 501c4s can engage in unlimited lobbying that's, in furtherance of its purposes to promote social welfare. They can also engage in some political activity, but that political activity can't be the organization's primary purpose. And that's certainly a distinction from 501c3 organizations altogether, because 501c3 organizations can't engage in any campaign activity, regardless of whether that organization is classified as a public charity or as a private foundation. There's an absolute prohibition on political activities. In the 501c4 context, that's different. 501c4s can engage in some political activities so long as that's not the organization's primary purpose. When a 501c4 engages in some political activities, the organization is subject to tax under Section 527. That's another provision of the code that does relate to political organizations, and it also provides for a tax on 501c4s related to their political expenditures. That tax is set on the lesser of the organization's net investment income or its political expenditures. And so while 501c4s can engage in some political activities, those activities are subject to tax. And an alternative to a 501c4 when exploring an interest in engaging in political activities is the use of 527s, which are, Lauren mentioned the fact that Schedule B, which just provides the schedule of donors, doesn't need to be disclosed to the public. In the 501c4 context, 527s are subject to a lot more in the way of public disclosure requirements. But they're certainly used as vehicles for, individuals, organizations that want to engage in more significant political campaign activities. Should also note that this concept of primary purpose is under scrutiny, and we'll talk a little bit more about it in a couple of slides. But going to the next slide, which I will turn to, relates to the definition of lobbying. And there are a number of definitions of lobbying that come into play whenever looking at an organization's lobbying activities. Certainly Diara and I are advising clients all the time on the tax definitions of lobbying, what is and isn't lobbying. And I should say that under the tax laws, certainly, I mentioned 501c3 charities can't engage in any lobbying, and foundations can't engage in any lobbying, but there are carve-outs from the definition of lobbying, and those are always important to keep in mind. So there are specific exceptions related to the provision of technical advice, self-defense, nonpartisan analysis and research. And so when exploring whether an organization at the 501c3 level is engaged in lobbying, it's important to also test those activities against the exceptions and whether or not the activity is more aligned with an exception than what would constitute lobbying under the tax laws. But there are other lobbying concepts that apply to organizations. There's the Lobbying Disclosure Act, which is a federal law that picks up on various lobbying activities and requires disclosure. There are also state lobbying disclosure acts. There are also local jurisdictions that have their own lobbying rules, and there are different underlying policy rationales. And so while we are often advising clients on the tax law considerations, there are also state, local, LDA considerations that come into play that don't necessarily, the definitions don't always align. So it may be possible that an organization is engaged in lobbying for state, Lobbying Disclosure Act purposes, but it doesn't meet the federal tax law definition of lobbying. And so it's just always important to be reviewing activities with kind of the multiple lenses in mind. Okay, so the next slide talks a little bit about political engagement, political activities. Similarly, there are multiple layers of regulation, federal tax law, the excise tax that I mentioned. There are also campaign finance laws, registration, reporting, disclaimer requirements. But really one of the key considerations that's coming up for 501c4s relates to this question about how much political campaign activity is too much. And there isn't clear guidance on how this is measured. I mentioned the primary purpose test, and that's been the concept that has been explored for a long time in our practice. So long as the 501c4 organization's primary activities are not political activity, then that should be fine. And so traditionally there was a view that, somewhere around 40% of activities might qualify, but that concept is changing. More and more we're seeing the IRS impose a standard that looks at whether or not the 501c4 organization has a substantial non-exempt purpose. And that looks at a threshold that's much lower than what we have traditionally viewed as applying when looking at an organization's primary purpose. And there have been some cases, and currently are some cases that are testing this concept. So this is a question that's coming up in courts as well. And so to be determined in terms of where things land around how much political campaign activity is too much to jeopardize an organization's exemption. Certainly, if an organization is contemplating engaging in significant political campaign activities, then there is the possibility of doing so through the 527 organization. So I'll stop there.
Great. Thanks, Kim. And this is sort of a recap slide because I think we've covered a lot on it. So I'm going to use this slide as an opportunity to catch up on some of the questions that I'm tracking in the Q&A chat in no particular order because I've just been scribbling while I saw the questions come in. Let me just cover a couple of them. And Lauren and Kim, please feel free to weigh in if you want to add anything. So Dick asked, can a private foundation make a grant to another private foundation? And the answer to that question is the foundation has to exercise what we call expenditure responsibility in that scenario. So expenditure responsibility has a few components to it. One, there has to be a pre-grant inquiry. There has to be a fair amount of due diligence. When the organizations know each other very well, that due diligence about whether the entity can, is in a good place to handle and steward the funds. There has to be a written grant agreement, and that written grant agreement should specify that in the event that the dollars are used for any purposes other than the intended charitable purposes of the grant, the foundation granting the funds can and will seek a refund. We'll seek repayment of the funds. And then finally, expenditure responsibility grants are reported on the grantor foundation's 990 PF on a special schedule. So when you're making grants to a private foundation, there are heightened documentation requirements and diligence requirements, but it can be done. Let me answer a couple of Jennifer's questions. One was, can a private foundation that exists, a C4 and a private foundation that exists in the same sort of family philanthropy ecosystem, can they have board overlap and such? The answer is absolutely yes. This happens all the time. We see it all the time, whether the organizations are set up organically as part of the ecosystem or whether the C4 comes later, which is more often the case because they have some philanthropic strategy and they want to add in advocacy as another angle from which to pursue the same mission that the charity has. Oftentimes there's overlap. There's more times than not overlap in the leadership in the C-suite as well. Might have the same executive carrying two business cards. What I want to emphasize is corporate formalities, corporate formalities, corporate formalities. Both entities need to have their own board book, their own records, obviously their own books and records. So it's really going to be important to monitor the lines as to when one board is meeting and when another board is meeting, even if it's like 2 out of 5 of the same people or 3 out of 5 of the same people, the minute books need to reflect different meetings. So we can talk about that offline anytime if you want to, but I wanted to cover that question. And then another question from oversight of C4 grants. I think Lauren covered this briefly. If a C4 is making a grant to a public charity, just as if a private foundation were making a grant to a public charity, we don't ordinarily expect or require heavy degrees of due diligence. If it's in publication 78, if you look up on GuideStar and you see the public charities in good standing and you want to make a general support grant, a pretty straightforward transmittal grant letter should suffice if you have limited resources or limited tolerance for administrative hassle. But if a C4 is making a grant to a C4, or if a C4 is making a grant to a foreign charity, I always recommend, as a best practice, some of the same types of due diligence exercise, the written grant agreement, the follow-up, and the pre-grant inquiry that you would see in the expenditure responsibility context that I just discussed in response to Dick's question. So I think it really depends on the context. I think it depends on the purposes. If you're making a project grant, invariably you want to have some strings attached so that your grantee, so that you're holding them accountable to actually use the funds for what you're granting them for. And that always requires an agreement, right? Happy to discuss that one also offline.
And
to
Diara,
Marjorie. Next.
I was gonna bring up go for Marjorie, and then we'll talk about grants from a private foundation to a C4 organization, and we can talk about that after the Marjorie one. I was just gonna bring up a couple
we actually have a whole slide on that I thought we would just skip to.
Cool.
Kim was going to cover grants. Yeah. So, but to Marjorie, the answer is unfortunately no. You can't just raise your hand and say we're converting, with a simple box checked on your 990 or something. This really does require another engagement with the IRS and an application. In the old days, if a C3 failed on audit, critical elements of C3 requirements, but could have qualified as a C4, it could just fall back as a default to C4 status and walk away from the audit, in effect converted. But then we got the PATH Act, and that's no longer possible. So you actually have to either do an exemption application, or actually that's what you have to do. You have to do an exemption application to in effect convert. Doesn't necessarily mean you have to dissolve your corporation and form another one, but it does mean you have to go to the IRS to get to apply. So
and I just wanted to add, because Marjorie asked if they find themselves wanting to participate in lobbying, and as we've mentioned, 501c3 charities, can engage in lobbying, and so certainly, that is always a possibility, and just wanted to include that reminder that 501c3s can engage in lobbying, and they can follow sort of a facts and circumstances test that measures lobbying, or kind of more specific expenditure test that measures lobbying.
Yes, I totally agree. And I see we have another polling question between us and the grant slide that I wanted to get to answer the other question. So do you want to do the poll now?
Yeah, let's get the third one out of the way here. So it is, what is the most compelling quality of a 501c4 organization? And your options are A, the flexibility and purpose, B, the ability to undertake lobbying and political activities, C, estate tax exclusions, or D, no private foundation excise taxes. And hopefully we can get through this one real quick so we can get to more Q&A. And then I also want to make you aware of a survey that we've set up where you can provide feedback for today's sessions. And that's located in the handouts window of your console, and your feedback is appreciated.
Awesome.
We'll do a few more seconds.
I feel like we've covered a bit on affiliated entities, which I'm happy to loop back to, but I want to go first, Kim, to the grant making slide.
Okay.
Oh, yeah. Flexibility and lobbying and political activities are in the lead, which makes sense. Yep. Okay, great. So I love nothing more than talking about affiliated entities. So many, especially here in DC, so many organizations operate as a companion set, a C3, usually called the Education Foundation or the fund, and then a C4 action fund that does the lobbying and systems change advocacy as part of the same mission. So I'll happily come back to this slide, but I really want to be responsive to the questions that we're getting. So I'm going to skip it for now and go to making grants. Take it away, Kim.
Great, thanks, Diara. So yes, foundations can make grants to 501c4s. And so the thing that foundations really need to pay attention to are ensuring that they follow the expenditure responsibility requirements. And Diara and Lauren both referenced those requirements. Diara kind of walked through them in more detail, but generally speaking, that requires the pre-grant inquiry. The foundation needs to have a grant agreement with a 501c4 organization that requires the use of funds for charitable purposes. We talked earlier about that 501c4s have 501c3 plus purposes. So when we're looking at the grant agreement between a foundation and a 501c4, we want to ensure that there's a specific use of funds that's tied to the more narrow purposes associated with 501c3 status. And the grant agreement also needs to include prohibitions on lobbying and campaign activity. There needs to be a requirement for the 501c4 grantee to provide access to the books and records and to maintain the books and records. There are annual reporting requirements associated with expenditure responsibility grants, as well as a final report. There's also a requirement to repay funds that aren't used for charitable purposes. And so many foundations may already be familiar with the expenditure responsibility requirements. They come up in connection with grants to other private foundations, as Diara noted, as well as non-taxable or non-tax exempt entities. So they come up in a variety of contexts, but these are the rules that are going to apply for grants to 501c4 organizations. And then we also wanted to note the fact that foundations can also make grants to 501c3 organizations that engage in lobbying. One, there is a provision of the tax laws under Section 4945. The regs make it very clear that foundations can make general operating support grants to charities that lobby, so long as the grants aren't earmarked for lobbying. There's also a special rule under the Section 4945 regulations that allows foundations to follow what's called the project grant rule to ensure that they can make a grant supporting a project of a 501c3 charity that lobbies, and that project can include some lobbying, so long as the foundation follows this project grant rule, which looks at the amount of the foundation's grant and the non-lobbying portion of the grantee's budget, and ensuring that the grant doesn't exceed, the amount of the grant doesn't exceed the non-lobbying portion of the budget. There are some additional nuances, but essentially the goal is really just to help foundations understand that grants to 501c4s are possible, and when making those grants, they need to follow expenditure responsibility, but then also grants to 501c3s are possible under certain contexts. And as I mentioned earlier, there are also exceptions to the definition of lobbying under the tax laws. And so foundations might, want to be making grants to 501c3 organizations for activities that actually, don't meet the definition of lobbying for federal tax law purposes.
Great.
So
I think we need to go to our next poll.
Yes. So the last polling question for this session is, did the IRS make it too easy to obtain 501c4 status? And I'll shorten up these responses to yes, maybe, or no.
And I think this got moved before we talk about how we obtain C4 status. So with that, Diara will launch into that, but just feel free to answer how you feel fit in the moment. Diara, do you want to take it away with
most of our content on the formation for last, knowing that we would want to get into stuff along the way in the discussion. So you're welcome to use those slides as resources. The high level points I want to make sure you take away, though, are a C4 can be formed just as a C3 can be formed. Some people do the corporate form and some do the trust form. People have, depending on the client, we talk about priorities, we talk about succession planning, need for flexibility, all these things that go into whether the trust form or whether the corporate form is best. So it's jurisdiction. I will say, I don't know, 90% of the C4s, just like 90% of the C3s I form, are corporation for all reasons people aware, but the organization has a connection to a particular nexus. Maybe you get funding at the state level.
I want to pause really quick. I think that Diara is breaking up a little bit.
If you are incorporated, different reasons also should be discussed. Another important consideration for forming can self-debate. Oh, sure.
Sorry, you're breaking up a little bit. We're not really we're able to hear little bits, but I think we can summarize.
Am I? Sorry.
Yeah, and so it's. And there's a lag, I think, so you're not hearing us right away, but it's okay. I think we can briefly summarize the next slides while your internet gets, because we only have a minute left. But I think Diara was saying that most of the organizations form in a state that works for them where their operations are, but there's also other popular states like Delaware. I don't know if that's what you said, but that's something that, you can talk to an advisor about. But the kind of important part that we want to bring up here is that 501c4s, they can just self-declare. They don't need to actually obtain a determination letter from the IRS. They can notify the IRS of their intent to operate under 501c4. They have to actually do that within the first 60 days of forming. But then it's optional for them to file a exemption application, a 1024A, with the IRS. We wouldn't really recommend, though, going that route. Like, getting that determination letter from the IRS is golden. It approves what you're going to do. It approves your social welfare purpose. So going through and obtaining that tax exemption determination from the IRS under C4 is probably a good idea. So sorry we missed kind of more of that information on that formation structure. Feel free to reach out to Diara or Kim on that. That's their area of knowledge as attorneys, and we appreciate them and that knowledge, especially us on the tax side, having attorneys like Diara and Kim who can help our clients in figuring out the best formation structure for them. But with that, I want to thank you both and for being here. I want to thank the audience for their incredible questions, and I'm going to pass it over to Amy to close us out.
All right. Yes, thank you all for another great presentation. And to our audience, this concludes the morning session. Join us for our afternoon session starting at 11:50 Pacific time. You can each click on the widget located on your screen or use the login link that was emailed to you when you registered. And thank you, and enjoy your break.
Nice job. Thanks.
Thank you.